Global financial markets take a time out as US-China trade wars commence. Global trade wars unofficially commenced this week. Canada's retaliatory tariffs against US steel tariffs come into effect on Sunday, including 25% on assorted US metal products and 10% on over 250 US goods, including whiskey and orange juice. $34 billion worth of US tariffs on Chinese products took effect from midnight Washington time, with the other $16 billion coming in the next 2 weeks. China is widely expected to announce retaliatory tariffs today, and risks remain that the US retaliates against them. Despite this, US and European equity markets have had a good week so far, helped by a number of factors. German Chancellor Merkel faced down a rebellion within her coalition over migration on Monday. Comments from the PBOC Governor Yi about keeping the yuan stable helped lift sentiment on Tuesday. The US 4th of July Independence Day holiday acted as something of a circuit breaker on Wednesday, and US FOMC minutes released on Thursday underscored the committee's view of a very strong US economy and the need to continue to gradually raise rates. Thus, we head into a period of sharply rising US-China trade tensions, with markets unusually calm. However, if we look slightly deeper into markets, we see increasing signs of concern. The FOMC minutes highlighted the need to keep monitoring the flattening of the US bond curve as it approaches an inversion point. The US 2s10s curve has a good history of predicting US recessions about 6 months down the track. US yield curve flattened further this week to under 30 basis points. That's a fresh low since 2007. Now, there could be a number of factors lessening the reliability of the yield curve as an indicator, not least aggressive asset purchases from central banks. However, given the historical relationship, this will be closely watched by financial markets. The FOMC minutes also noted discussions on the possible adverse effects of tariffs and proposed trade restrictions, both domestically and abroad, on future investment activity, while some contacts in some districts indicated that plans for capital spending had already been scaled back or postponed as a result of uncertainty over trade policy. Now, a rising sense that trade wars will do more harm than good to US economic activity saw the US dollar lose some ground into the end of the week. The RBA statement Tuesday was also a little less positive on the global front and acknowledged uncertainty around the rise in Australian short-term wholesale interest rates, though it retained the core view of growth averaging a bit over 3% and an eventual lift in inflation. One significant change was the guidance on the Aussie dollar. For the last 25 consecutive meetings since April 2016, the RBA has argued an appreciating exchange rate could or would be expected to result in a slower pickup in economic activity. For no obvious reasons, this guidance was dropped this week, with the RBA instead noting simply the Australian dollar has depreciated a little but remains within its recent range. Perhaps this suggests the RBA is happy with the current level, though we await guidance from the RBA minutes in 2 weeks' time. While the shift in guidance did not have an obvious impact on the Aussie dollar on Tuesday, the combination of soothing comments from PBOC Governor on the yuan and a softer US dollar helped the Australian dollar recover from a fresh 18-month low at 73.11 on Monday. Also helping sentiment was strong thermal coal prices, which have been driven higher by stronger demand out of Asia, including China. Newcastle thermal coal prices hit $116 per tonne last night, the highest level seen since February 2012, though it's worthy of note that iron ore prices hit 3-month lows below $63 on slower Chinese data and concerns about the impact of trade wars. After a slightly better than expected, though still modest 0.4% lift in retail sales in Australia for May, attention next week will turn to measures of confidence. June NAB business confidence is due Tuesday, and the July Westpac Melbourne Institute Consumer Sentiment Index plus May housing finance approvals are released on Wednesday. Given this relatively low-key calendar, the focus next week should remain offshore, especially on the developing US-China trade tariff situation. Given the Aussie dollar appeared to be more sensitive than most to such headlines, the Australian dollar is likely to continue to struggle in the mid-74s. These are all factors we can talk about in next week's Markets Update.